The world of cryptocurrency moves fast, sometimes too fast. In this digital frontier, fortunes are made and lost in the blink of an eye, and the pace can leave even seasoned investors breathless. Just a week ago, Bitcoin was flying high, trading near $58,000. Investors were euphoric, convinced the only way was up. The mood was electric, with celebrations echoing through trading floors and online forums alike. Social media buzzed with stories of overnight riches and skyrocketing portfolios. FOMO was everywhere, pushing people to invest more than they could afford. Tweets and posts painted a picture of endless opportunity, fueling a frenzy that swept up both newcomers and veterans. The market felt unstoppable, but beneath the surface, risk was quietly building. Many traders weren't just buying Bitcoin, they were using leverage, borrowing money to amplify their bets. The stakes were higher than ever, and few paused to consider the dangers. Leverage can supercharge gains, but it also magnifies losses. As more traders piled in, the market became a powder keg of speculation. The promise of quick wealth blinded many to the risks lurking in the shadows. Margin calls and liquidations loomed as silent threats, ready to strike if prices faltered. For some, the excitement masked the reality that the higher you climb, the further you can fall. By the end of January, cracks began to show. Bitcoin struggled to break past $58,000. The momentum that once seemed unstoppable began to stall, and uncertainty crept in. Some analysts warned of a correction, but most ignored the signs. The optimism was blinding. Dissenting voices were drowned out by the roar of bullish sentiment. The market was perched on a knife's edge, primed for either new highs or a sudden collapse. The stage was set for a dramatic turn. Every tick of the chart felt like a drumbeat before a storm. What happens when confidence turns to fear? The answer was coming, fast. In a market built on emotion, panic can spread like wildfire. The house of cards was about to face its first real test. In crypto, fortunes can change in a heartbeat. The difference between triumph and disaster can be just a single headline or a sudden price swing. The market was holding its breath. The next move would decide everything. Every investor, big or small, waited for the signal that would shape the days to come. The storm was about to break. In the world of Bitcoin, calm is always just the quiet before the chaos. The collapse hit without warning. In a matter of moments, the entire market was thrown into chaos, catching even seasoned traders off guard. On February 2nd, Bitcoin's price nosedived, falling over 15% in just a few hours. The drop was swift, brutal, and relentless, leaving little time for anyone to react. From $58,000 to below $49,000, panic swept the market. The air was thick with disbelief as traders watched their screens in horror. Traders woke up to devastation, red screens, wiped out accounts, and a sense of helplessness that spread like wildfire. This wasn't a slow decline, it was a violent liquidation event, a sudden storm that erased fortunes in minutes. Exchanges automatically closed $2.5 billion in leveraged positions. Traders who had borrowed heavily were forced out, their positions liquidated at a loss. The market was purging itself of risky bets, flushing out over-leveraged players in a matter of seconds. The speed was shocking. No circuit breakers, no pause, just relentless selling and mounting losses. As prices fell, more leveraged positions were forced to close, fueling a vicious cycle that drove prices even lower. There was no time to react, no safe haven to run to. Even the most experienced investors were left scrambling. For many, dreams of easy wealth vanished in minutes, replaced by the harsh reality of risk. The $2.5 billion in liquidations represented shattered hopes and empty accounts, proof of how quickly fortunes can turn. The dangers of leverage had never been clearer. What seemed like a shortcut to riches became a trap for the unwary. How did it unravel so quickly? What triggered this chain reaction? The answer lies in the mechanics of leverage. and the risks traders ignored, blinded by the promise of fast gains. The digital gold rush had become a digital avalanche, sweeping away anyone who wasn't prepared for the risks. The lesson was brutal, but unmistakable. In crypto, nothing is guaranteed. In crypto, risk is always lurking just beneath the surface, waiting for a moment of weakness to strike. Leverage is the secret weapon, and Achilles' heel, of crypto trading. It's a tool that can turn small moves in the market into massive gains, but also into devastating losses if you're not careful. It lets traders control big positions with little money, magnifying both gains and losses. With leverage, your initial investment acts as a deposit, while the exchange lends you the rest. With 10x leverage, a $1,000 bet becomes $10,000. This means you can potentially earn 10 times the profit, or suffer 10 times the loss, compared to trading without leverage. If Bitcoin rises 5%, you make 50%, but if it falls 5%, you lose half your money. The swings are amplified, making every price movement feel like a roller coaster ride. The temptation is obvious: fast profits, big wins. For many, the thrill of multiplying their money in minutes is irresistible, but the risk is just as real. The same leverage that can make you rich can also wipe you out in seconds. A small drop can wipe out your entire investment. Liquidation happens fast, often before you even have time to react. Some exchanges offer 100x leverage, a 1% move against you, and you're done. The higher the leverage, the thinner your margin for error. During the rally, traders piled in, convinced the price could only go up. The excitement was contagious, and risk was easy to ignore. When the market turned, there was no buffer, just a cascade of losses. Margin calls and liquidations swept through the market, leaving many with nothing. Leverage is a double-edged sword, and in crypto, it cuts deep. It can build fortunes, but it can also destroy them in an instant. The recent crash was a harsh reminder: high rewards come with even higher risks. In crypto, leverage can be your greatest ally or your worst enemy. So, what happens when a leveraged bet goes wrong? Exchanges use automated systems to protect themselves and close risky positions. If your losses approach your margin, the exchange steps in and sells your assets instantly. There's no waiting, no second chances. In a crash, thousands of liquidations can happen in seconds, flooding the market with sell orders. Traders lose their entire margin, sometimes even owing more. The process is ruthless, but necessary to keep the system stable. On February 2nd, this automated wave wiped out billions. For those caught in the storm, it was swift and final. The lesson? In leverage trading, you're always one step away from disaster. The market doesn't wait for you to catch up. When the margin is gone, so is your position. Most of the $2.5 billion in losses came from long positions, bets that Bitcoin would keep rising. The optimism was overwhelming. Everyone was on the same side. When the price dipped, the most leveraged longs were liquidated first. Their forced sales pushed the price down further, triggering more liquidations. This chain reaction, a long squeeze, fed on itself. Each wave of selling triggered the next, creating a domino effect. The market's one-sided bets became its undoing. What started as confidence turned into a self-inflicted crash. The lesson: when everyone's betting the same way, the risk of collapse skyrockets. In crypto, collective optimism can quickly become collective ruin. The chaos centered on a few major exchanges: Bybit, Binance, and OKX. These platforms are the battlegrounds for leverage trading, processing billions daily. Their automated risk engines closed positions en masse, accelerating the crash. Many traders couldn't even log in to save their accounts. Platforms lagged or froze. The exchanges did what they were designed to do, but the experience was harrowing. Their power is immense. A few platforms can move the entire market. When the liquidation engines fire, there's no escape. The lesson in crypto: the house always has the final say, and when the tide turns, it turns fast. What triggered the first domino? Profit-taking by big players, regulatory fears, and global economic worries all hit at once. Whales locked in gains, while rumors of new regulations spooked the market. Macroeconomic uncertainty made investors risk-averse, pushing them out of crypto. These forces combined to start the sell-off. In a market overloaded with leverage, it only took a small push to start the cascade. The result, a modest dip became a multi-billion-dollar crash. In crypto, the smallest spark can ignite a firestorm. After the crash, panic ruled, but some saw it as a healthy reset. The liquidation flushed out reckless speculation and excessive leverage. Markets built on borrowed money are fragile. Corrections clear out the weakest hands. With leverage purged, prices can rebuild on a stronger foundation. Like a controlled burn, the crash made way for healthier growth. Painful lessons were learned about risk and greed. These resets forced the market to mature. For Bitcoin to be taken seriously, it must move beyond cycles of pure speculation. Corrections, though harsh, are steps toward a more stable future. In crypto, survival means learning from every fall. What's next for Bitcoin after the crash? Volatility will linger as traders weigh fear against opportunity. The biggest lesson: leverage is dangerous. Fast profits can mean faster losses. Responsible trading means managing risk, using stop losses, and never betting more than you can afford. The crash exposed the risks of concentrated trading on a few big exchanges. Calls for better platform design and user education will grow louder, but the fundamentals of Bitcoin remain unchanged. The network is strong. The technology endures. For believers, corrections are buying opportunities, not the end of the story. In crypto, caution and education are your best defense.